Hey guys, hope you're doing well out there. Probably one of the simplest earnings we can find out there is that of Amazon.com's, and that's exactly what we're taking a look at today. After they reported their Q2 results, shares are sliding nearly 4% in the after hours. That is despite shares being down close to 2.25% during the regular trade. When we get to the technicals, you can see this one is breaking through a level of support. Certainly, if it continues to head lower, we'll highlight some levels where it might make sense to step in and buy this one. With earnings season rolling right along, let's take a look at shares of Amazon that are up nearly 20% year to date. But keep in mind, over the past month, you are down close to 6%. And then again, in the after hours, you're seeing that sell off of nearly 4.5% at this point. Now, the reason for that is because they came in with a revenue miss. Despite revenues growing 10.2% up to $148 billion, that missed consensus estimates by right around $760 million. So Wall Street on their midpoint was expecting nearly 10.7% growth up to, call it, close to $149 billion. Amazon coming in just shy of that at right around $148 billion flat. In terms of the bottom line GAAP EPS, they did come in with a solid beat of $1.26, beating estimates by nearly 23 cents. Now, they did say the second quarter net income includes a pre-tax valuation gain of nearly $0.4 billion. That is due to their investment into Rivian Automotive. And so keep in mind, some of this bottom line earnings is affected by that investment into Rivian. What I like to see with Amazon is the revenue, but more importantly, the operating income. And we'll get to that in just a second. In terms of their different segments, the North American e-commerce business growing at 9% year over year, international e-commerce growing at 7%, and then the all-important AWS business growing at close to 19%, coming in at $26.3 billion. Very strong growth on their most profitable business. That is what we like to see with Amazon. Now, before we get into the Q2 print more in depth, let's take a look at third quarter guidance, which is what I think is sending shares down close to 4% in the after hours. So their third quarter revenue coming in a bit lighter than what Wall Street anticipated for, as Amazon is guiding for revenue to be in the range of 154 up to 158.5 billion. The consensus on Wall Street was closer to 158.3 billion. So Amazon on their midpoint, if you assume a $156 billion revenue number, that would be about $2 billion shy from the average estimate that Wall Street was hoping for. And certainly when Wall Street is anticipating nearly 11% growth on that revenue, and then Amazon is guiding for close to 8 to 11%, yeah, they're coming in a bit light on that top end, at least from a revenue perspective. And I think that is enough to send shares down nearly now 5% in the after hours. Certainly when you have a revenue miss in this quarter and then a smaller guidance upcoming for the Q3, yeah, that certainly can spook investors just a little bit. I think that's nothing to worry about in my opinion, and certainly I think a 5.5% downward move could be an overreaction to such a small miss in your Q3 guidance, and certainly that's not something that I'm overly concerned about. The other thing they mentioned in their guidance is they're expecting operating income to come in between 11.5 up to $15 billion. That would compare pretty favorably compared to last year, where operating income was nearly $11.2 billion. So I think Amazon is now moving away from a revenue growth story to basically being an operating income growth story. As the operating efficiencies begin to kick into this business, you'll see the operating income is really what gets me excited about a name like Amazon. Now, in terms of the North American e-commerce business, we see right here, operating income jumping from $3.2 billion same time last year up to nearly $5.1 billion. So despite growing your revenues just 9% on that business, you're controlling your operating expenses relatively well, allowing your operating income to expand much faster than your revenues, really, again, kicking in those operating efficiencies. Similar story on your international e-commerce side. In fact, I'd say even more exciting, as you're turning from an operating loss of nearly $1 billion to now eking out an operating income close to $300 million. Now, keep in mind, look, $300 million over $31 billion of top line sales is very, very small margins. But I think at this point, Amazon was all about growing that top line business, growing those top line sales, both on a North American and international e-commerce side. Now they're going to be looking to kick into those operating efficiencies and get that operating leverage through to pass down those operating profits to you, the shareholders. So I think the operating income for this international side is just beginning to kick in. You give it a couple more quarters, a couple more years, and yeah, this business, while it probably won't ever catch up to the North American side, it will probably be a meaningful step up in terms of operating profitability over at Amazon. Because you see, over the last 6 months, last year you lost nearly $2.1 billion on that segment. This year, so far, you've gained nearly $1.1 billion. So the flip to operating profitability is pretty significant on that international e-commerce side. Now, the all-important AWS, which remains the cash cow for this business, is continuing to hum along just fine. You have revenues come up from 22 billion up to nearly 26 billion dollars, and your operating income adding that nearly dollar for dollar up from 5.4 to now at 9.3 billion dollars in operating income. Just see how well they've controlled the operating expenses on that AWS side. So you're growing your top lines nearly 19% and hardly budging your operating expenses there. And so AWS becoming more profitable than it really has ever been in the past. And that's exciting. What's also exciting for the AWS business is that the revenue growth rate on that side has been accelerating since last year. So last year at the same time, we saw 12% growth on the AWS side. This year, we saw nearly 19% growth in this quarter. So the most profitable parts of Amazon continue to grow at the fastest rate. And along with that, along with AWS growing at nearly 19%, you also have the advertising business, which in my opinion still is a very underrated part of Amazon, growing at 20%. Yeah, that's right. One of the biggest, in fact, the number 3 biggest business over at Amazon behind their e-commerce and behind AWS remains advertising, and that is growing at 20% year over year, coming up to $12.7 billion in this most recent quarter. So advertising remains a key focus for Amazon. Keep in mind, this is actually bigger than YouTube. If you remember from last week, YouTube posted close to $8 billion in ad revenue. Amazon advertising is at $12.7 billion at a quarterly run rate. So again, the scale of this advertising business is, I'd say, far often overlooked. On top of that, probably the margins on this business are far juicier than your e-commerce business. And then the growth rates you're experiencing on that side, again, north of 20%, is very nice to see. That is the third head of this three-headed monster. Probably one of the biggest reasons why I am bullish on Amazon is due to that advertising business continuing to just take off like a rocket. In terms of total net sales, again, coming in at close to $148 billion, significant increase, nearly 10% up year over year. And again, the operating expenses is what this company is keeping in check so well. Your cost of sales taking up just $4 billion, fulfillment also having to increase along with those net sales up just $2 billion, and then your tech R&D staying relatively flat, up a casual $400 million, and then your sales and marketing, they actually drove those down. G&A also ticking down to $3 billion. So your operating expenses coming up just around $7 billion, despite adding nearly $13 billion to your top line. And again, that will nearly double your operating income, coming in at $14.6 billion. That is really the number I would pay attention to over at Amazon. Their net income certainly can be manipulated just a little bit due to that Rivian investment. And so the operating income is what I want to see explode over at Amazon. And over the last 6 months, your operating income coming in at nearly $30 billion. Same time last year, we were just a shade higher than $12 billion. So again, this is the reason why you're staying invested in Amazon, is because as the scale economies, as the leverage really kicks in, this company shows it on its operating income side. From its balance sheet, this company having enough cash to really take on any project and continue that capex investment that we'll see in just a little bit. Your cash and equivalents coming up to $71 billion, an additional $17.9 billion in marketable securities. That's offset by right around $54 billion in long-term debt. Yeah, they just simply have more current assets than pretty much all of their total liabilities. In fact, a lot of their liabilities come in the form of their lease liabilities, which they simply offset by having nearly $220 billion in property and equipment. So from a balance sheet, you really have nothing to worry about, except for the fact that what is Amazon going to use this cash for? Because they certainly can't go out and do any acquisitions. That will swiftly get shut down by really anyone in Washington. They certainly don't do a big enough buyback at the current time, and they don't have a dividend. And so all that cash is sort of just sitting there right now, earning them interest. But as interest rates begin to come down, yeah, they'll likely have an urgency to put that cash to use. We'll have to, I guess, wait and see where that cash really goes. In terms of cash flows, we come down and see nearly $25.2 billion in operating cash flows, significantly higher. Same time last year, we were at 16.4. Now, the all-important property, plant, and equipment capex line, this is where we see a lot of these mega cap tech spending just a fortune on. At the current time, we saw Meta spending $8 billion yesterday, Amazon spending nearly $17.6 billion in this most recent quarter on the purchase of property, plant, and equipment. Certainly a lot of that flowing down to NVIDIA, flowing down to AMD, flowing down to your semiconductor names. So again, probably proving bullish for them, considering this capex spend on the data center build out will likely continue for the foreseeable future. Now keep in mind, they are seeing a return on that, I'd say, from their AWS side. So probably one that you would want to see continued spend in that capex, especially when they have just such a large amount of cash sitting on their balance sheet. It's not like they have a big use for that cash, at least at the current time. So I would certainly expect this capex spend to increase as we head into the end of this year, and certainly be higher in 2025 than we have seen in 2024. Now, your remaining free cash flow of nearly $8 billion for the most recent quarter, some of that is put to use in the form of repaying down your long-term debt, and then the remaining is just sort of shoved into your marketable security. So this company, again, not paying out a dividend, not really doing a buyback at the current time, certainly one they can maybe look to start at some time down the road. Now you have shares sliding nearly 5% in the after hours, coming down to $175 a share. This one had been on an elevator ride higher, basically in a textbook uptrend since December of 2022. Looks like that has most recently been broken down. You're now coming underneath this support line at $177 a share. Certainly if shares of Amazon continue to slide, probably open lower than $177 tomorrow, you might see a reversal, but what I would actually anticipate is this one to continue to head lower, coming down to $160 a share. The $160 range really is a bed of support from, call it, back in 2020 to all the way to 2021. So I certainly wouldn't be surprised if this one comes down in that range and sort of channel sideways between $160 up to $177. That is a level where I'd probably look to add shares into Amazon. Certainly there's nothing in this print that tells me this company isn't continuing on this trajectory of growing their operating cash flows, growing their free cash flows into the foreseeable future. And so as it continues to head lower near $160 a share, that is where I'd probably look to add Amazon fairly aggressively. I'd say if you want a 10 share position, you could probably look to add up to 2 to 3, if not 4 shares at that point, because you certainly would be pulling back from your all-time highs near $200 a share. If this one does come in here and reverse tomorrow, yeah, I'd say your upper head resistance is probably back up here to $200 a share. That's probably where Bezos is stepping in and looking to offload some of his shares, and so that could put a ceiling on the stock. In the meantime, though, I expect this one to channel sideways between 160, call it, up to $179 a share. That is where I would look to add into Amazon. Certainly if you are overweight this one, this is a level where you can continue to hold. I think there's nothing overly concerning about this one selling off at this point, because you still have tremendous fundamentals backing up your story over at Amazon. That was my take on shares of Amazon.com, a growth story which I think has the legs to continue and is just now ramping in its free cash flow and operating profitability. Let me know your thoughts on this one in the comment section below. One, I probably might step in and pick up a share or two tomorrow. As always, thanks so much for listening, and I'll catch you guys in the next video.